Welcome to the wonderful finance vertical, where again we have Matt Heller and Lattery as our guests. Just so everybody aware, the information provided in this vertical does not and is not intended to constitute legal and or financial advice. Instead, all information is for general information purposes. Guests attending this vertical should contact their attorney and or financial expert to obtain advice with any respect to any particular legal financial matter. All right, now that we've got the disclaimers out of the way, I want to welcome Lattery. Flo is our chair of our Denver 2 group. She has over 30 years in financial services. She's worked in technology, finance, operations at Merrill Lynch for 22 years in New York, New Jersey, and moved to Denver in 1995 as a client service department manager, supporting branch offices in Central and Western US and their territories. She has been a franchise owner, a real estate investor, and currently is a commercial lending broker. Flo, welcome, and thank you.
Thank you, Sean.
Second, we have Matt Heller, who co-founded Willner Heller, LLC, a registered investment advisory firm located in Encino, California in 2003. Willner Heller manages money for individuals, businesses, nonprofits, foundations using equity, fixed income, and alternative investment strategies on a fee-only basis. Matt has been featured in the Wall Street Journal, Forbes, LA Magazine, San Fernando Valley Business Journal, just to name a few. Matt has also been named a 5-star wealth manager 5 times. 5 times. So Matt, welcome.
Thank you.
All right. Flo, are you ready to answer the hard questions I got for you?
Absolutely. Shoot.
All right. Well, we'll start out easy. I know this is John Grace's favorite thing to talk about, real estate. Let's talk about some real estate, Flo. So how will office real estate affect the rest of the commercial real estate market? So talk to me about that, Flo.
Great question. So let me just set the stage when it comes to commercial real estate. And in particular, how does office real estate fit into the scope of commercial? Recently, Professor of Finance Jacob Segi at the Keenan Institute was asked that question. He was asked the question, is there a crisis in commercial real estate? And he said the office sector is a looming crisis, but it's far from representative of the entire scope of CRE, commercial real estate. Because this office sector is only 15% of the total commercial real estate. Total commercial real estate is a $20 trillion plus enterprise as part of the US economy. And offices are 15%. But the impact that offices will have or is having on on the rest of the commercial real estate is the severe downtown. We know the impact of COVID, right? COVID happened, people went home, people don't want to come back to the offices. And so we have all this vacancy. So what we end up with here is it could lead to a prolonged economic downturn. We could see widespread defaults, we could see bankruptcies, we will see job losses, and all this affects the economy as a whole. Right here in Denver, every city has their landmark buildings, right? And 2 buildings downtown Denver that's part of the skyline, they went into receivership. Those owners of those buildings cannot pay their mortgages. So what they've done is said to the banks, well, you got to take the building back because we can't pay you. So we're going to see this kind of result. And the trickle-down effect from that is when they can't pay their mortgages and they turn these buildings back into the banks, what does the lender do? The banks are going to look to the citizen and say, hey, I can't pay my taxes here. Okay, I cannot afford to pay taxes. The building isn't making any money. I'm not making any money. Can't afford the taxes. Who's going to pay those taxes? That's going to end up on homeowners. So there is a Oh, even though office is only 15% of the commercial real estate market, this is the kind of impact it could have across the board economically, down to the individual level. The individual homeowner will be impacted. So it can be pretty far reaching for such a small segment of the economy, of the marketplace.
All right, and thank you, Flo, for the first question. Good warm-up question. I should have mentioned this, and my apologies. If you all would like to submit a question to one of our panelists, please put it via the chat. Please put it via the chat. We're going to give an opportunity about 15, 20 minutes at the end to open up for a Q&A session. So, Matt, you and I have talked. You talked to me about the evil R word, and you know the R word I'm talking about, the recession word. So, are we entering recession, or are we in now? Or are we not going to go to recession? Matt, what do you got for me?
Well, that's a great question, Sean. It's very timely. And I'd like to thank Sean Detzer for inviting me to serve on the panel. I also lead the Encino group, and we have a number of our members on today. I'd like to thank them for participating. Jenna, Brian, and Abe, thanks for coming on and being part of the panel. This is my first Highrise panel. Recession is a question we get a lot from our clients because it's been talked a great deal about in the media. You know, politicians have discussed this. Are we in one? Are we going in one? I think the data is pretty clear, at least at the moment. This could change fairly quickly, but I don't think we're in a recession today. However, there's a very strong indication that we will be in one probably later this year. I know John Grace and I have talked before about, you know, looming market correction and, you know, the chances of a recession. And while it's possible that we could have a soft landing that the Fed has discussed in terms of raising interest rates to combat persistent inflation, there's an article earlier this year in the Wall Street Journal that was entitled, "The Fed has never gotten this right. Why do you think they will now?" And again, as we were discussing before we really got on the vertical, perception is often reality. And if people think that we're going into a recession, that affects their spending and their saving habits. And you can actually save your way into a recession. And we're starting to see some evidence of that. Corporate earnings are still strong, but it's selective. Unemployment is at historic lows, but it's been ticking up slowly. And if companies think that they're going to have less revenue going into next year, then they're going to you know, pull back. They're going to start looking at reducing staff. So I don't think we're in a recession today, but I think there's some strong evidence that we will be in one soon. And Tanya, I'm sorry I didn't see you on. I saw you just put in a note. Tanya's one of the newest members in the Encino group, and she joined the call as well. So Tanya, thank you for being here.
All right, Matt, let me ask you a follow-up question just because we were talking about recession, and then Flo, I'll come back to you for your next question. So you talked about it, you know, we're not in one now. How can I expect the equity markets themselves? So specifically talking about the equity markets, how would a recession likely affect that?
Well, it's a great question. I think that once it becomes abundantly clear that we're entering a recession, the equity markets will react badly. I think that we've got one more good correction in this current market cycle. It could be a 10% correction, could be a 12% correction. I know John Grace thinks it might even be more than that. But clearly markets don't react well when you're facing a recession, which includes higher unemployment, slower growth, reduced corporate earnings. However, I think that we've been in a cyclical bear market for close to a year and a half. And when that time finally comes, when it becomes clear that we're in a recession, I think that will be the last big dip that we see, because the financial markets are a leading indicator. They're looking 6 months out, 1 year out. Well, what happens? What does the government typically do when you're in a recession? How do they react? Well, typically you don't raise interest rates, you likely lower interest rates. Now, I think inflation will be persistent for some time. So I don't see rates going to zero. We're not going to see a scenario like we remember from the financial crisis or even from the COVID crash, where the Fed cuts rates to zero. But they will start incrementally easing once we are in a recession. That will help equity markets. And while not all companies will perform well during this time, Some will perform very well. I don't know if anybody follows NVIDIA, but they're one of the leading companies in the AI space, and they've had a tremendous spike this year. I think they're up about 44% in the last month or so. So I think once we can get through the big R word, once it becomes clear that we're actually in one, things will initially be bad for stocks, but that will be, I think, the bottom. I think that's when we'll find the bottom of this current market cycle, and that should usher in the ascendancy of next bull market. So I'm looking forward to that. And we're preparing the portfolios, we're staging the accounts to be prepared for that possibility.
So Flo, to continue on our apparently very upbeat, that's what you want to know. We love doing upbeat verticals here on Monday. So in our very upbeat vertical that we're having today, Flo, let's go back to talking a little bit about real estate, but specifically that CRE, that commercial real estate.
Mm-hmm.
How's that going to impact the economy? How is take now for the next year, if you could, how do you think commercial real estate will affect the overall economy?
Okay, so we talked about where office buildings fit into the overall scope at 15% of the commercial real estate space. Well, the other sectors within that space includes residential, such as apartment buildings, retail, which includes malls and strip centers, industrial, fulfillment, warehouse types, hotels, and anything in that hospitality sector, medical facilities, senior care, data centers, cell towers, marinas, and the list goes on. So it's a very diverse sector. The challenge here is that you have this ricochet effect, okay? I just had a lender, an investment group tell me that they're pulling back on financing hospitality. However, I have a client who is buying a couple of hotels, and she said to me, well, are they branded? So because they are branded, they have a certain brand name. She said, yes, we will do those. But now they're looking specifically if it's boutique, if it's a non-brand or a brand that's not one of the larger brands, they just won't fund it. So we see this problem trickling through the economy. Here is a insight for you. I was reading counselors, CRE counselors of real estate. They came out with the top 10 issues facing commercial real estate. Number 1 is inflation and interest rate. 2, geopolitical risk. 3, hybrid work. 4, supply chain disruption. 5 is energy. 6 is labor shortage. 7 is the great housing imbalance. 8 is regulatory uncertainty. What are counties versus state doing in terms of regulating how you use land? Cybersecurity interruptions, ESG requirements forcing change. That's pretty broad. There's the top 10 categories that will affect commercial real estate going into the future. So it's pretty significant, the space this holds and the impact it's going to have right down to the individual level, because it's going to impact revenues, it's going to impact tax base, it's going to impact availability. We know that we have a huge issue in the residential space with affordable housing. And when counties or cities start dictating what you can put on your land, regulating land use, it just increases the potential for more impacts. So it's pretty broad scope. We think of commercial real estate as big buildings, but it's going to impact basically every segment of the economy.
So with a very, very broad stroke, if you could, Flo, with the deals that you're seeing go through lately, with just talking specific commercial real estate, are you seeing any different, when they are financing it, are you seeing any overall difference in LTVs or terms
absolutely.
that you've seen different, let's say in the past 5 years overall? Mm-hmm. What are you seeing?
Anyone coming to me for 100% financing, I think it's a joke. Okay, I'm like, you're not living in reality. I have lenders right now, they're looking at 50% loan to value. I have one as a call tomorrow morning, one of my clients and a lender. He is refinancing properties worth 3.6 million. He's asking the debt is 3.6, the value is 7.6, and none of my lenders will go over 50% LTV on that particular deal. Loan to value, if the property is worth 7.5 million, we're going to give you 3.25 million. So the LTVs have come way down. Now, there is another sector for very large loans, large construction project. You've got to be at least $10 million and up, and you can still get 100% financing on ground up construction. On acquisitions, they're funding 80%. I have those 2 hotels I was talking about that my client's buying. He is going to get 80% loan to value. But there are some other contingencies that are included in that loan, like his down payment and what he has to put up to get to that 80% LTV. But there's no such thing as 100% financing, with the exception of a very large construction loan where, and for that, you're going to have to bring, it's going to be a 5-year term, interest only at about 6.5, 7, but you're going to have to bring 20% of the loan amount to be deposited in an interest reserve account. So when you make a draw from that line of credit, the fund, the trust, is going to draw the interest. They're not going to send you a bill to be paid. They want that interest reserve deposited. So every time you take a draw, they pull their interest, prepaid interest.
And Flo, just real quick, and then I want to go back to Matt. But for those of us that aren't in commercial lending, such as yourself, to give us kind of an idea, we heard 50% LTV. What were you seeing before this? I mean, I doubt it was 100% every single time. So on average, LTV that we were looking at before, try to give everybody a general idea of how much has changed recently.
It was 75, 80%. There
you go. So 25, 30% difference in what you're seeing.
Oh, yeah. And the rates are, rates are going up on that. Plus, there are some lenders have prepayment penalties. So if it's a 3-year term and you try to pay it off in 18 months, it's going to cost you more. It's going to be more expensive money.
All right, Matt, let me try to ask you another question. So we talked about recessions, right? So what can I do overall? And if you could maybe talk about just briefly, maybe from the personal side and maybe from the corporate side, what can I do right now to likely prepare for a recession?
Well, I think probably the first thing you'd want to do if you're a business owner is to bifurcate your costs, something akin to want and need. If in fact we are in a recession later this year, if in fact earnings are down, if in fact your business is impacted, the one area you can control are your costs, certainly more than your revenue. So in good times, it's very easy to do add-ons, to say, okay, you know what, I want to add a marketing team. I want to add a search engine optimization team. I want to be able to spend more money on outreach or whatever it is. I think you need to look very carefully at your costs and see what your ROI is and say, all right, am I getting real bang for my buck here? And if I am, great. There's something to be said for taking advantage of a bad situation and expanding your market share. But, there's also throwing good money after bad. And if you're not getting the kind of return on your investment that you're hoping to, then you want to start dialing back your costs. That way you'll have less of an impact to your bottom line if revenues start dipping. From a personal financial standpoint, you can kind of do what we're doing in our portfolios that we manage, which is right now you're being rewarded for the first time to hold short-term money. We were buying treasuries last week that are 3 weeks out that are paying over 5%. I would start shifting a portion of your money to either liquid CDs or short-term government bonds and ladder them out over the next several months. I think we will have another major correction, and we're going to use that as a buying opportunity. We're not looking at putting a lot of money into long-term bonds because right now we have an inverted yield curve and you're rewarded much more handsomely for staying short-term than you are long-term. But we're looking to play this market correction. And we did this in the financial crisis 15 years ago, and we did this 3 years ago when the COVID crash occurred. You can get a lot of value out of the equities markets if you buy the dip. And the bigger the dip, the more value. And typically you're sitting on cash and you're not being paid very much on that money. Now you are. And you've got a rare opportunity in life at this very moment to put money into a short-term fixed income vehicle, get paid, and then have a vehicle become liquid and mature at a time when maybe you can buy the dip in the equities markets and kind of get in on the ground floor of what I think will be the ascendancy of the next bull market.
Appreciate you. We'll come back. Flo, going back to you on this one. So 2 questions I wanted to ask. You had mentioned a reserve before the loans before. Is it, I read it on the internet, so we all know it must be true because I read it on the internet, right? But it was something to the effect of that, you and I know that banks or lenders, they can get an estimate, or not an estimate, a value, get a value on your loan. And, the article is basically saying if the property was worth $3 million when they did the loan, but now it's worth $2 million. They're asking for a down payment. They are asking for you to put money in reserves if this happens, or they're calling the loan. Are you seeing this happen?
I am not seeing that happen. Where there's an outstanding loan and they're calling for more capital to put in reserves. Is that what you're asking?
Yeah. So when I did the loan originally, it was worth $5 million. We've done a new valuation, and now it's worth $3 million. And obviously, there's that loss. They're either calling the loan or they're asking to put more in reserves immediately.
Yes.
What we're seeing is the reserves without necessarily calling the loan. But if you can't do it, they are calling the loan. Have you seen an increase in this?
I haven't seen an increase in that, and we're originators, so we're originating new loans. Most of it, we're not a bank where we're holding the note. So we're not seeing that part of it. What I'm seeing from clients coming to me who are in that situation is I have one right now that I'm working on. It's a refinance out of a debt where the lender, a private lender, is going under. And they've called all their loans. I mean, they just hit the wall. This was a very, very highly experienced group. This gal had built an investment firm that was bought by one of the big banks, and she had a 5-year non-compete. Well, the 5 years are up and she jumped back in and she started another fund. And she's been lending locally here in Colorado, this deal is, but then something went sideways with her lending and she's going out of business. She's calling this loan due right now. So I'm scrambling, trying to help my client get that debt refinanced. The tricky thing about it, these is not like a building, it's finished lots. These are housing lots where the curbs are in and the water and all the technology, everything is been what they call the horizontal is all done, but the houses have not been built yet. Now, having all of the horizontal done does increase the value. And he does not want to commit other properties to a loan because a lot of lenders will not lend against land, even if they're finished lots. They just don't want land. They want a building that if they have to take it back, they can lease it to a client. Can't do much with land unless go build on it. So it's been a tricky one to do, but that's a case where a lender is in trouble and called his loan due.
Thank you. I appreciate you answering that one. Let's go back to commercial real estate. I love to talk to you about commercial real estate. So other than office buildings, I think there's a big concentration on that right now, but other than office buildings, what are the key issues affecting commercial real estate currently?
Well, the key issues affecting commercial real estate is the portfolio performing, okay? I have a client who is, this is residential, but they're portfolio. So there are hundreds of homes in a portfolio. And some of the big banks are starting to sell off those portfolios. So he's come to me for a line of like $10 million so he can buy some of these, because he has a direct line to some of these large investment groups. They're starting to sell off their portfolios. So that's that's one of the impacts we see, that, you know, investors are looking, am I overly extended? Do I have too much in my portfolio? How do I find balance? How do I get cash? Okay, how do I get cash that I can hold in reserve instead of having all my money invested? At the same time, there are people who are looking for investment. So it's a trade-off. You know, who wants to get out? Who's looking for opportunity?
So Flo, we talked about a lot of the negative, right? Or maybe not
Yes.
negative, just more factual, right? We're going to go more factual on that one because Flo is a very positive person.
Absolutely.
More factual, but let's talk about an upside. There has
Oh,
to be
yeah.
an upside. So is there an upside at all to commercial real estate right now?
Oh, this is what we call opportunity. What does Warren Buffett say? When there's blood in the street, you buy. Well, there's blood in the real estate market. And there are certain groups that are leveraging this to acquire. CBRE just came out with a survey that found that more investors are expected to implement debt strategies that are going to get them money to buy properties. And actually, Artemis is a real estate group out of Maryland. Deborah Harmon is the co-founder. This woman has just amassed $2.2 billion in equity commitments. And all she's going to be doing is buying distressed real estate. That's it. She is amassing billions of dollars to go out and buy these defunct office buildings because they will be discounted. Banks who are taking them back do not want to keep them on their balance sheet. They need to get them off their balance sheet. They will fire sale them. I heard of a sale in California where a building was sold for like less than 50% of what it was valued at because they just had to get rid of it. So here is, and this is just, Artemis is just one example of portfolio of investment groups who have the wherewithal to go out and raise this kind of capital and be prepared to go around the country shopping for office buildings especially. Now, what are they going to do with them? Are they going to convert them into something else? Possibly. Are they going to just hold and wait? If they have the wherewithal, they will hold and wait. They'll pay the taxes and they'll hold and they'll wait it out. Because this whole situation could turn around in 24 months. And that's what some of the predictions I'm reading. This is going to go on. It could be 2 years. But if you can hold a building in a prized location, maintain it, pay the taxes for 2 years, the market will turn and, you could see a return on that investment.
So I appreciate you. I'm going to have at least one or two more questions for you. So I'll give you a chance to breathe for a second, drink some water, and we're going to go back to Matt. So sticking in the positiveness, Mr. Heller there, what opportunities do you see for investments on the horizon? Again, if you could go personal and corporate, would definitely appreciate it if you don't mind.
Well, I think Flo explained it really well. When there's blood in the water, that's when you want to get in. Uncertainty inherently breeds opportunity. And I think Flo articulated it very well in the real estate world. You can do that in stocks too. And in fact, that's what we're counting on. We get paid to manage clients' money. And it's not a set it and forget it proposition. You need to take kind of what the market gives you and be able to find opportunities. Interestingly, when we're in the midst of a severe downturn in the equities markets, the smart people in my space are kind of high-fiving each other saying, you want to know what? Everything's on sale. I don't think we're going to see another extreme downturn like we had in 2020 or in 2008, 2009, but just, alluding to the financial crisis, we were buying Amazon at $40 a share. I think Apple was around $30 a share. And these are all adjusted for splits, and that was a long time ago. But you could pick up US banks for $1 a share. Citibank was trading at $1. I think Bank of America was at $2. Wells was a bit more expensive. They were around $9. These are things that we do every day when we see opportunities like that, which is not often. But if we are in fact going into a recession, if we are going to see a significant correction in the equities markets, people can take advantage of that, and you don't need to hire me to do it. You can do that, in your E-Trade account and in your Schwab online account. And, you can pick quality companies at a reduced price and be able to create some real wealth through what's essentially not a good time in the stock market. That's what we do professionally, but you can do it personally as well. To Flo's point about real estate, if you're a commercial real estate investor, there's got to be opportunities there. That's her area of expertise, not mine. But you know what? If loan to value has gone from 75, 80% to 50%, that's a significant change in lending practices. And that's got to give one some ideas of how do we take advantage of this situation? So if you don't want to look at the negative, you want to look at the positive. When everybody's running out of the burning building, if you're the person who buys it, they'll eventually put out the fire, and you're the owner.
Well said, Matt. Well said. That image will be stuck in my head. So Flo, help me get that out of my head here. So we keep talking about the housing market,
Okay.
What's the impact of the housing market going on right now?
Well, of course, it's funny because I had this conversation earlier today with somebody else, and I was just using Denver as an example. What is the impact on housing? We know that prices went through the roof over the last couple of years. Denver, again, as an example, we saw all these companies moving to Colorado the last few years. They push prices up in single family homes and rentals. I mean, the construction here has been totally out of control. And people who live like in Denver, who are used to their neighborhoods and all of that, they've seen the growth and they've seen everything getting crowded. I hate driving north on I-25 to go to Denver in the afternoon because everybody's on it. And what we've seen happen is how people are moving. I live south of Denver. I live in Douglas County. And south of where I am is a town called Elizabeth. This is horse property. This is where you buy acres and you build a big house and you have lots of land. And so there was just an article published here about people moving out of Denver. They're not moving out of Colorado. They're just going south. They're saying, I don't want to live here with all the crowd and the traffic, and I can't afford, if I want to buy something larger, or I want to downsize, I can't afford it here. I'm going to go south in Douglas County and further out in the rural parts of the city where I can get, lot more acreage. I can have a nicer home, won't cost me as much. And literally it may add, 15 minutes to your commute to Denver. So we've seen that kind of response in the marketplace locally. Adam Data Solutions came out with an article recently that said that only 1.25 million residential mortgages were originated in the first quarter this year. That's the lowest number since 2000. First quarter 2023 origination was down 19% from the fourth quarter 2022. The 8th straight quarter of declining loan origination, which means people just, interest rates are going up. Homes are too expensive. If I sell where I am, what am I going to be able to afford to buy someplace else? So the number was down year over year, 56% basis since 2001, first quarter 2001. So you see that big shift in residential. We've seen rental costs going up. We don't, the oxymoron is affordable housing. There isn't any such thing anymore. I read an article that literally said that affordable housing is an oxymoron. Okay, this again is the impact of, people deciding to stay home and work, They want to be in a nice space. They want to be in a comfortable space. If they're in an apartment, is that enough space? If I have a family in a 2-bedroom, can I really work from home, or do I go to the coffee shop and work and all of that stuff? There's so much. COVID has created a total change in the way we think, in the way we live, and the way that we are going to operate going forward. I had a young woman reached out to me on the internet for a loan. And so we set up a call, and we have a Zoom call, and she's on a patio in this beautiful, lush place. And I'm like, where are you? She was in South America somewhere. She wasn't even in the country. Of course, I couldn't help her. She was a small business. She needed a small loan. I'm like, I can't do that. But she was in Costa Rica on a beautiful patio. Okay, she left. She can't afford to live here. She's growing a small business. It's all internet based. She's living in a country where the cost of living is so much lower. She just needs a little bit. And now at that point, I said, you need friends and family to help you.
Okay, I'm doing something wrong because I'm living in Vegas and not Costa Rica. So thank you, Flo. I apparently need to look at my address again.
Yes.
Matt, we're going to stay on the positivity.
Flo, I wonder how much she pushed up the cost of housing in Costa Rica by moving.
I know. I'm sure she's renting, but yes, this is an American coming to Costa Rica. She can afford to pay whatever the rent is there, but
well,
that's
right.
Pretty.
That's how the affordable housing becomes unaffordable.
Exactly.
Matt, we're gonna have to stay on the positive side here. So the positive side. So people always have liked to tell me where to go, but you don't get to do that, Matt. But you do get to tell me where I should put my money. You do get to tell me where I should put my money. So where should I be putting my money right now?
Well, it's a tremendous question. From a portfolio management standpoint, we've got a scenario that we haven't seen in many, many years where we've got, higher interest rates than anybody's used to. Not just a little higher, but a lot higher. A lot of folks in my space, would joke about the 60-40 portfolio split where you traditionally had 60% of your portfolio in equities and 40% in fixed income. The problem was even before inflation became a thing again, rates were so low that at best you were breaking even on the fixed income sleeve in your portfolio. And at worst, you were probably losing a little bit of purchasing power every year. And again, this is before inflation ratcheted up. Well, now you've got an opportunity where you can put some real assets into fixed income. And the time to get into the bond market is when rates peak. And we've got to be pretty close to that now. I don't know if people are looking at their phones to check where the equity markets are today. That's something I do once or twice a day. They're way up. And what's driving the market today is sentiment on Wall Street that the Fed is going to pause its interest rate hikes this month.
Oh, really? Good.
Which is, well, and it's not news. I mean, that was reported in the journal last week that they probably pause in June. And I think they even gave guidance that they're going to pause in June, but maybe resume in July. But I mean, we only have maybe a couple more interest rate increases left because at some point, and that's probably now, the Fed is going to start doing structural damage to the economy. Again, before we kind of got on the call, we were talking about the bank failures, Silicon Valley Bank, Signature Bank, First Republic. The more they raise rates, the more that's going to become a real problem among small and mid-sized banks. Not to mention borrowing is going to become prohibitively expensive. Flo sees that every day in her world. But in terms of where to put money, you can start adding fixed income back into your portfolio now. Once it's clear that the Fed's done raising rates, and that's going to be right around the same time that we realize we're in a recession, then you want to lock in some longer term bonds. Then you can go out longer than a few months and you'll be rewarded for it. And right around that same time, when we get the next correction, that's when you should be buying stocks. You can buy blue chip stocks that are on sale. You can certainly get into some mid cap selectively. Typically, I'm not a fan of owning small cap single issue stocks. However, small cap stocks typically lead us out of a recession. So if you know what you're doing, you're very careful. You can even get into the small cap arena. And if you don't want to buy, individual issues in small cap, there are a lot of funds and ETFs which will get you into that and diversify you. And you should see some outsized returns. And to Flo's point, I think probably a year from now, we're going to be in a lot better shape than we are today in terms of equity prices. The economy might not be in better shape, but again, the market is a leading indicator. And if it's looking down the road, I think this will be a mild recession. Stay positive, stay truthful. I don't think this is going to be a major financial crisis. I think that it's going to be a fairly benign downturn that we're going to be able to, claw our way out of fairly quickly. But between now and then, there's going to be some buying opportunities in both bonds and stocks.
I want to thank you both. Obviously, I'll try to come up with some more hard questions for everybody on here. You can go ahead and either raise your hand, or you can go ahead and put your questions via chat. But I do want to call on somebody before that happens, because I've seen Mark Forsyth is our resident bankruptcy guy on the call, and throughout the time, yes, no, kind of shaking his head, kind of going along with it. So, Mark, what do you see through your world? Sticking with the theme of what we've been talking about today, kind of walk us through the bankruptcy world, what you're seeing, and are we in a recession? How's it being affected? So, a couple minutes, sir. The floor is yours.
Sure. Well, thank you. Thanks, Sean. Maybe repeating some of the comments, but I don't see residential being the problem it was back in 2009. Basically, a lack of supply, a lot of people not wanting to sell their homes with low mortgage loans, going to a higher mortgage loan, and a tremendous amount of equity. I think I read somewhere 30-40% of the homes in the US don't have any debt on. So I don't see residential being a problem. The one comment by Flo regarding a property was actually 354 California Street, kind of an iconic building in San Francisco that was valued at $300 million back in 2019, and it's on the market right now for $60 million. And one of the primary reasons is the major tenant, I think it was Union Bank, basically did not renew their lease and left, and they can't refill it. And so, repeating the obvious, the office market is going to be interesting to see how that falls out, and the dominoes that fall out from the office market. You have people servicing office markets, right? You have local restaurants that are not getting business flow. So it's not just the owners of an office building; it's all the related people that are feeding off that. And it'll be interesting to see how that falls out. Yeah, we're getting a lot of calls on distressed real estate, we probably work out 80% of our cases versus filing, because if you really know what you're doing, you present to the lender what's going to happen in bankruptcy, and usually try to work it out. Personal guarantees are playing a big factor in whether you file bankruptcy or not, or the negotiations. If the personal guarantor is very solvent, then you're not going to get a whole lot of negotiating going on. But in the right situation, a debtor entity can file with an office lease. Maybe they have a 10-year office lease. You can file a bankruptcy. You don't have to be insolvent to file bankruptcy. You can reject that lease, cap your lease damages at 1 year, and get out of bankruptcy. So that I provide that advice to a lot of office tenants as an option. But once again, you have to look at the personal guarantee on that. So, bankruptcy is a great threat for negotiating. Doesn't mean you always have to go through, but I'm pretty good at threatening. So.
Sounds like when I used to punish my kid. Never punish him, but I would threaten to do it. I would threaten to do it. Maybe not fall through as often as I should. Yes. George, I'm going to apologize for mispronouncing your last name ahead of time, and I should know how to pronounce it. But George Whittemire, you're an investment banker. Can you come off of mute and tell us kind of what you see affecting the market, deals, investments that you're having differently now?
Sure. I mean, it's difficult for everyone, and certainly lending terms are tougher for those buyers of companies that would seek debt financing as part of the structures that they employ. And it doesn't matter whether you're an established private equity buyer who's been doing this for a long time, Anyone who didn't already have a facility that was negotiated and not yet expired had to renew it, and will do so at much more difficult terms. So it's really very similar to the sorts of things that Flo and Matt have been saying, frankly.
Appreciate you, sir. Opening up to the group, can we save the office buildings? I'd like to hear everybody's opinion. I know sometimes I've heard, we can turn them into apartments. Do not think we should have that many apartments going on, and the rent's going to get out of control. But again, I am not the expert on here. You all are. So can the office, if people stay at home, can we do something else with the office buildings, or are we just looking at a lot of demolition? I open this up to either our panelists or anybody on the floor. If you are not our panelists, please raise your hand so I don't have everybody talking all at once. Please.
Well, Sean, I'll
Okay,
just
I'm about to say, somebody raised their hand. Come on, y'all. Okay, Flo, help me out on this one. Help me out.
I'll just say we've been here before. I mean, we've seen downturns, we've seen cities with boarded up buildings. 30 years ago, Denver didn't look anything like it does now, because there was a lot of when we had the energy crash years ago, it affected this state pretty badly. I remember being down 20 years ago, being down in Pueblo, Colorado, and everything was boarded up. Everything. I mean, everything along the river, it was decimated. The city was decimated. Today, Pueblo is a thriving city. The Riverwalk is there. There's a big Marriott on the Riverwalk. There are all kinds of, restaurants and patios and all of that. So the bottom line here is, we're in a challenge. We're in a challenging time. And it's not just in real estate. COVID has created a complete shift in everything we do and the way we live and the way we work. Nothing is going to go back to the old normal. This is a new normal. And we will get out of this. It's going to take us a couple of years, but we will get out of this, and some of us will come out better than ever before. And, there's going to be blood. But again, if there's blood on the streets, that's when you go shopping. So I'm not all about the gloom and doom. I see the opportunities. I see my clients who are coming to me with opportunities, like these two young guys, these two young men, and they just want a line of credit so they can go out and buy portfolios of houses and turn around and rent them. And so there is a silver lining. So I would caution that we don't get totally disillusioned that this is going to be, we're going to go into a massive recession and our lives are going to be over. No, real estate is a cyclical business. It always has been, and I think it always will be, and it just needs something to trigger a cycle. And this time it's COVID. But I think we'll come out of this.
Flo, thank you. Because of this vertical, I'm not blaming on anybody in the vertical, but I'm going to announce no talk about blood going on future verticals. There's a lot of talk about blood today. So
in the streets, go by.
I know. I get it, Flo. John Grace, you chatted me saying that you want to chime in. Jim, you'll go after that. And then my two panelists, I'm going to ask you one more question. So be prepared for that one. So John, you got the floor, sir.
Well, I think when COVID came around, we all said we will get through this. We'll be right back to where it was. And let's just recognize that did not happen. Let's understand, we all drink the same air. We breathe the same air, drink the same water, and fly the same airplane. So I think it makes sense for us to look not from history and say what happened in the past is going to happen in the future. I think we should be looking beyond what has happened in the past and turn on our GPS and let's see what the future holds. And I also think it makes sense to not say, it's going to be, we're going to get through this, everything's going to be fine. No, we work a lot with engineers, and I love engineers. Why? Because they want to know what's the worst case scenario you can see. And if I can weather that, I'm good. If I can't weather that, maybe I want to do something else. But let's look at the worst and prepare. Hope, what do they say? Hope for the best and prepare for the worst. I think that makes sense. So here's one of the things that staggers my imagination, and this is reality. In the late 80s, we knew Japan was going to be number one. The stock market peaked 1229.89, close to 40,000. dropped 80%. A year later, Japanese real estate dropped 70%. The trick question I like to ask is, which has come back to even? And the answer, Jim Better would be able to tell you because he knows how to fill in the blanks. It's not about knowing the answer. It's following the line of, it's a trick question. And he would say, along with others, neither. And that is the correct answer. Now, just wrap your mind around, it's over 30 years later. Neither the stock market in Japan nor the real estate market in Japan has come back to even. Further, when it comes to real estate, they have 11 million homes abandoned. They only have like 62 million homes. And in one source I can find in the article I wrote, they say in the next 10 years, they expect the number to go from 11 million to 33 million. You've done the math, that's 50% of homes vacant out of a population of 127 million. And here's the thing that's happening there, and it's happening everywhere. We're getting older. Globally, we have more people over 65 than ever as compared to 5 and younger. So, just to say, hey, when interest rates come back down, it's going to be just the way it was. I got to help us understand. You've got Mother Nature and Father Time. They're the real, trump cards. They hold all the cards. And the average age of death in Japan is like about 80. And in the US, it's about mid 70s, and our number keeps going down and their number keeps going up. So I'm just saying, cash is king. I'm submitting to you, now's the time to get your cash. We pay for independent research. They're suggesting they have no product to sell, and I think that's important. Don't be surprised to see real estate in commercial areas drop 40%, residential areas drop 50% across the country. Might be as little as 17% in Nashville, as much as 70% in Phoenix, high 50s Southern Cal, low 60s in Northern Cal. And don't be surprised that you see that the stock market repeats what happened in 2002, which nobody saw. That was stocks off 80%, NASDAQ off 90%. Only took, 15 years for NASDAQ to come to even, assuming you did not take out $1. So I'm saying, folks, now's the time to get your cash, put it on the side, and catch the next wave. But what do they say? Cash is king. What do they say about equity? Crickets.
Well, John, I'll say this. The only thing I will correct you on simply is you are the one exception to Father Time. So happy 21st birthday, sir. You are not getting older. Happy 21st. Want to let you know that. Jim, and then Alex will be our final person. Then we will go wrap it up with our 2 panelists. Jim, you're up, sir.
Thank you. I just wish I could be as articulate as John Grace is, but not nearly as scary. California is very different in a lot of different ways, but we call it the People's Republic of California. But it's not different in having an aging population, as John said, and thank you for teeing it up, John. California's population in 7.5 years is predicted to be 1/4 of the population. 11.5 million people will be over 65 years old out of a population of 40. What does that have to do with real estate? Assisted living, residential care. I see a lot of these places. It's not going to have a big impact, but it's going to have some impact in the real estate market when these developers say, hey, I could take this low-rise building and chop it up into residential units and put a kitchen in it and bring in some nursing staff. I see that because the need is there.
Sorry.
And I think some of the real estate issues are going to be resolved by the very fact that so many of us are getting older.
Jim, I appreciate you. Alex, want to give you a chance. I think you put your hand down, but if you want to come off mute and ask a question or make a comment, we'd appreciate it.
Thanks, Sean. Well, we probably don't have enough time, and at the risk of opening up a whole can of worms, I will probably send Flo an offline message and get my clarification that way.
Okay.
Yeah, appreciate it.
Sure.
Well, Alex, we appreciate you, and Flo's fantastic. She'll respond, but at the second you send the email, Flo will be typing already, so I know she'll get back to you.
Yeah.
All right, Matt and Flo. We'll finish on an easy question. And again, I want to thank you both for your time and your expertise. I truly appreciate that. So Flo, I will start with you, and this is the last question I have. If you could only say one thing, what is the one thing that you hope everybody took away from this talk today? What is the one thing?
Well, first of all, Sean, thank you for inviting me to my first panel ever. I've enjoyed it, and I really appreciate you trusting me to do it. The one thing I'd like for you to take away is that change is inevitable in whatever we do, even and more so in our real estate markets. There's always change. Okay. I remember working in New Jersey, in Somerset, New Jersey, when Resolutions Trust came in and built the building next to us to solve the banking problem. Okay. That's how bad it was in 1989, I think it was. So we've seen crashes like that. We've seen challenges, but knowing that we're a resilient country with strong financial basis, and there is always a transition, there's pain, and then, you know, we get over that, we move on, and we get stronger from it, we learn from it. The banks that are failing, we understand, you know, now is going to be another look as to why they failed and how we can prevent that fail from happening again. So it's an evolution. The business world, the financial world, the real estate world is always evolving. So take faith in that.
Much appreciated, Flo. Matt, you got the last minute, sir. Actually, we're at the top there, but what do you got for us? What is the one thing you hope everybody took away from this?
Well, I'd also like to thank you, Sean. I'd like to thank everybody for participating in my first panel discussion as a panelist. The one takeaway that I would suggest is, you know, there's opportunities in chaos. You know, there's whenever there's uncertainty, there's opportunities to make money, to improve your financial position. There's going to be a lot of uncertainty over the next year in terms of interest rates, in terms of inflation, in the equities markets. We've done very, very well over 20 years being in business, buying the dip. And you can do that in your own portfolio. You can do that in your own life. You know, if you need help with that, there's plenty of professionals in Highrise who'd be happy to assist you. But rather than looking at the world from a more dour perspective, which the news media often portrays, take a look at the opportunities that are created in challenging times. And we've talked a lot about that in the last hour. And rather than being negative, be positive and look for some entry points where you can improve your financial position, because there are going to be many in the very near future.
Yeah.
I appreciate everybody, all of our experts on this call. Again, thank you, Matt and Flo, everybody who chimed in. If you are a father, I hope you have a wonderful Father's Day this weekend. Same bat time, same bat channel. We will see you all June 26th for the wonderful M&A vertical Gary will be leading. Thank you all. Have a great day. Appreciate your time.
Thank you,
Thank you all
everybody.
for being here. Take care. Bye.